Welcome to channel. Today we explore the fascinating connection between chicken farming and financial management in rural and semi-urban communities. Chicken farming is more than just raising birds. It is a structured system that teaches discipline, resource allocation and long-term planning skills that mirror financial principles without relying on complicated jargon or abstract theories. Instead, we focus on the practical lessons that emerge from everyday farm operations. When a farmer begins with a small flock, the first challenge is calculating feed requirements. Each bird consumes a predictable amount daily, and the farmer must ensure that supply matches demand. This mirrors the way households manage monthly expenses by tracking consumption and adjusting purchases accordingly. If feed is overbought, it spoils and money is wasted. If underbought, birds suffer and productivity declines. This balance is the essence of financial control. Another important aspect is record-keeping. Farmers who note the number of eggs laid per week, the mortality rate of chicks, and the cost of feed gain a clear picture of performance. These records act like financial statements. They reveal whether the farm is progressing or declining. Without such records, decisions become guesses, and guesses rarely lead to stability. In the same way, families or small businesses benefit from keeping track of income and expenses to understand their financial health. Scaling up chicken farming introduces lessons about risk management. When a farmer expands from 50 birds to 500, the stakes rise. Disease outbreaks become more damaging and feed costs multiply. This teaches the principle of diversification rather than relying on one source of income. Farmers often combine chicken farming with vegetable cultivation or goat rearing so that if one activity struggles, another supports the household. This mirrors how financial resilience is built by spreading resources across different areas of livelihood. Cash flow management is another lesson. Chickens produce eggs daily, but sales may not occur every day. Farmers must store eggs safely and plan sales in batches. This requires patience and timing, similar to managing cash flow in a small enterprise where payments may not arrive immediately but expenses continue to accumulate. The discipline of waiting for the right moment to sell teaches the importance of liquidity and timing in financial planning. Labor allocation also reflects financial discipline. A farmer must decide whether to hire help or manage the flock alone. Hiring increases costs but may improve efficiency. Managing alone saves money but risks burnout. This is a trade-off between expenditure and productivity, similar to deciding whether to outsource tasks in a business or handle them personally. The decision depends on weighing cost against benefit. Pricing strategy in chicken farming is a direct financial lesson. Farmers must decide whether to sell eggs at wholesale rates to traders or retail them directly to consumers. Wholesale offers quick bulk sales but lower margins. Retail requires more effort but yields higher returns. This choice mirrors the financial decision between short-term gains and long-term profitability. Understanding market demand and consumer behavior becomes essential for maximizing returns. Feed formulation is another area where financial thinking is applied. Some farmers buy commercial feed while others mix their own using maize, soybean and vitamins. Mixing requires knowledge and effort but reduces costs. Buying ready feed saves time but is more expensive. This decision reflects the financial principle of cost-benefit analysis, where one weighs convenience against savings. Savings and reinvestment emerge naturally in chicken farming. Profits from egg sales are often reinvested into expanding the flock, building better housing, or purchasing improved breeds. This cycle of reinvestment mirrors the principle of compounding growth, where small profits are reinvested to generate larger returns over time. Farmers who consistently reinvest build sustainable enterprises, while those who spend all profits immediately struggle to grow. Community cooperation also plays a role. Many farmers form groups to buy feed in bulk at lower prices or to share transport costs. This collective approach reduces individual expenses and increases bargaining power, teaching the principle of cooperative finance, where pooling resources leads to shared benefits and reduced risks. Finally, chicken farming teaches patience and long-term vision. Chicks take weeks to grow before they begin laying eggs. During this period, farmers must invest time, energy, and money without immediate returns. This mirrors the principle of delayed gratification in finance, where long-term rewards require short-term sacrifices. Those who endure the waiting period are rewarded with steady egg production and reliable income streams. In conclusion, chicken farming is a living classroom for financial discipline. It teaches budgeting, record-keeping, risk management, cash flow control, pricing strategy, cost-benefit analysis, reinvestment, cooperative finance, and patience. These lessons are not abstract. They are lived daily by farmers who transform small flocks into sustainable livelihoods by applying principles that echo financial wisdom without ever needing to mention complex terms. The farm becomes a teacher, the chickens become guides, and the eggs become symbols of steady, disciplined growth.